Understanding cash flows. Never take your eyes off the cash flow because it is the lifeblood of business. Meet Tim. He sells IT equipment to businesses and he does not worry about his cash flows. He just wants to sell IT equipment. Why should he worry about his cash flows? His business is making a profit. Having positive cash flows within a business is very important when it comes to staying solvent. A business can be making a profit and still have negative cash flows. Let's compare Tim's business with Scott's by taking a look at their working capital. Cash is king. The working capital is the cash of the business. Tim's bills come in for $9,000, but he has no immediate cash on hand to pay them. He only has $5,000 and he has no other immediate funds as his other current assets cannot immediately be turned into cash. Scott's bills come in $9,000 and he has the immediate cash in the bank to pay them. Tim could have the cash in the bank too, just by improving his cash flows. Having positive cash flows comes down to timing of your cash inflows and cash outflows. If your business has higher outflows than inflows, you're going to start running into problems and possibly insolvency. If Tim continues and does not make any adjustments, he will face the consequences. Tim needs to start considering his cash flows, or he will eventually run into problems and they will start impacting on his business. The impacts on his business could include the following: late payments to suppliers, late payment fees, or unable to pay at all. If Tim is unable to pay his debts in the short term, he is not going to be able to pay his debts in the long term. Tim will look to borrow more funds, which will not improve his cash flows and would further put his business at risk of insolvency. Further consequences are refused credit approval and suppliers could cancel credit, delays in customer payments, unable to trade due to the requirements of the Companies Act. Just because Tim's business has more assets than liabilities, if he is unable to pay his debts when they fall due, he will be considered insolvent and he would no longer be allowed to trade due to the requirements of the Companies Act. The same applies if your business has less assets than liabilities. The biggest impact could be the liquidation of his business. A business needs to be solvent in order to survive. The next slides will give Tim some tips on how he could improve his cash flows. Tips for improving cash flows. Run an outstanding debtors report to show potential cash flow improvements. For improving your debtors management, see my blog on how to get paid on time by your customers for more information. Prepare a cash flow forecast. You need to forecast when money will come in and out. This will help you work out the movements in regards to your cash flows. The cash flow forecast predicts your business incomes and outgoings. A cash flow forecast is only as valuable as the information and detail put into it. Payment terms with creditors. Negotiate your terms with your creditors. Review and reduce expenses. Review your pricing. Do some research. Do your prices compare with your competitors? Get expert advice. Having a fresh prospectus on your business will add value. The team at Accountable are very willing to help to identify ways to improve your business. improving your cash conversion cycle. This in turn will improve your cash flows. The cash conversion cycle calculates the number of days it takes from paying your supplier to receiving payment from sales. The diagram on the next slide shows you how the cash conversion cycle works. Cash conversion cycle. This diagram gives you an example of the cash conversion cycle. Tim buys 5 computers from his supplier and payment is required on the 20th of the month following. Tim makes the payment in 35 days. The stock then sits in his warehouse for 30 days until it is sold to a customer. Tim's payment terms are 20th of the following month. Tim then receives payment 45 days later. From the time Tim pays the supplier to the time when he receives payment is 75 days. If Tim reduces the cycle by just 10 days, he would be improving his cash flows. If Tim's revenue is $2,000 a week, improving his cash conversion cycle by just 10 days would improve his cash flow by $4,000. Why bother? For a small business, it does not take much for their cash flow situation to change. It just takes 1 or 2 customers not to pay. This can mean the difference between having positive cash flows to fighting to staying solvent. Research carried out shows us 1 in 5 businesses do not survive their first year. Only 2/3 make it through their second, and only 30% survive through 10 years. This is due to many different reasons, but one of the main ones is having inconsistent cash flows. If you are unable to pay your bills, you will become insolvent and you will be unable to meet your financial obligations. Next steps. If you would like any more information or have any questions, please feel free to contact Accountable or Specialist Collections and Consultants.